All right, let's talk about Culp, ticker CULP. Their latest earnings report is a real head-scratcher. It's like watching a tug of war. On one side, you have the company absolutely crushing it internally, getting their house in order. But on the other side, you've got this brutal market environment just pulling them down. So the big question we're going to tackle is, which side is going to win out?
So check this out. The headline numbers tell the whole story, really. It's a classic tale of two tapes. They absolutely smashed their earnings per share target, beating expectations by a whole 10 cents. That's a huge win on the profitability front. But, and it's a big but, their revenue missed by almost $7 million. Ouch. So you get this beat on the bottom line, but a big miss on the top line. That's the kind of mix that really gets Wall Street talking.
And how did the market react? Well, no surprise, it zoned right in on the bad news. The stock took a hit, dropping over 2%. So what does that tell us? It tells us that investors looked right past all the great work Culp is doing on the inside and got spooked by that revenue miss and the tough economy. The top-line number just carried more weight on the day. Okay, but let's not get bogged down by that initial reaction. Let's dive into the bull case, the turnaround story, because this is where things get really interesting. Culp's management is basically saying, hey, we can control the economy, but we can control our own operations, and man, are they ever proving it. And I mean, just look at this number. This is a star of the show right here. Their gross margin shot up by 530 basis points. That's a 5.3 percentage point jump, all the way to 14.3%. That's a massive improvement. It's the best proof you could ask for that all those painful restructuring moves are actually working. They are making way more money on every single thing they sell, even while sales are down. So what's the secret sauce? How did they pull this off? Well, it's basically a 1-2 punch aimed squarely at their costs. First, they finished up a big restructuring last year, consolidating their North American business. That alone is going to save them $10 to $11 million a year. And they're not stopping there. They've got this new plan, they're calling it Project Blaze, which is all about bringing their different business units closer together. That's expected to tack on another $6 million in savings. It's a really clear, powerful strategy. You know, the CEO basically said it all. He's like, look, we know our industry is in a really tough spot. No question about it. But we're not just sitting around waiting for things to get better. They're focused on what they can control, and they're executing. Right here, right now. You gotta respect that. But of course, it's not all sunshine and cost savings. We have to talk about the bear case. Let's flip the coin over and look at those external headwinds, the stuff that caused that revenue miss and has a lot of investors feeling pretty nervous. And when you break down the revenue, the problem area just jumps right off the page. The whole company's revenue was down about 10%. But get this, their bedding segment was basically flat. That's actually pretty good in this market. It means the entire problem, the whole 10% drop and then some, came from their upholstery business, which just fell off a cliff, down a staggering 20%. So what happened? What blew up the upholstery business? Well, it was one specific, really nasty surprise: tariff volatility. There was this crazy temporary spike in tariffs on imports from China. Management said it went over 150%. That's just insane. And it basically shut down the residential upholstery business for 5 whole weeks. No orders, no shipments, just a complete standstill. It was a total external shock, and it hammered their first quarter sales. So you've got this good news on the inside and this bad news on the outside. Where do they go from here? Let's take a look at what management is telling us to expect, both in their official guidance and what we heard on the analyst call.
The big theme from their guidance is simple: sequential improvement. Basically, they're saying Q1 was the bottom. They expect sales to start climbing back up in Q2, and this is key. They're guiding for adjusted EBITDA to be around breakeven, maybe even a little bit positive. The game plan is clear. Keep improving operations, watch the cash like a hawk, and start generating free cash flow. It's a back-to-basics, blocking and tackling kind of plan.
All right, so that's the story so far. You know what happened, and you know what management is saying. Now it's time for our take. This is the next call, where we give you our predictions, our rating on the stock, and an interesting trade idea. Looking ahead to Q2, we're actually a little more optimistic than the rest of the street. We're penciling in revenue around $52.5 million, just a touch above consensus. Why? We think that upholstery business is going to bounce back faster than people think now that the tariff issue is over. More importantly, we think all those cost savings will really kick in, leading to a slightly positive adjusted EBITDA of about $500,000. That translates to an EPS loss of just a penny, which, by the way, is a lot better than what the street is expecting. So where does that leave us? Our official rating on Culp is market perform. Look, you absolutely cannot ignore the fantastic job they're doing internally. The margin improvements are real and they are impressive. But you also can't ignore the fact that the home furnishings market is weak, and who knows when the next tariff issue might pop up. There's just too much uncertainty on the revenue side for us to get more bullish. It really is that perfect clash between great company execution and a lousy market.
Okay, but we do have a pretty interesting trade idea for you. We're calling this one the hidden asset arbitrage. Here's the thinking. The market is laser focused on the weak revenue on the income statement. And in doing so, we think it's completely missing some huge value tucked away on the balance sheet. For example, on the call, they talked about just one of their facilities having a market value of 40 to 45 million bucks, but it's only on the books for 12 million. That's a potential $30 million of hidden real estate value right there. And get this, they also have $88 million in NOLs. That's basically a giant coupon that will let them avoid paying taxes for years once they're profitable again. So the trade is this. You take a long position. You're betting that as Culp keeps proving it's operationally stable, the market will have to wake up and reprice the stock to include the value of these hidden gems. It's a bet on stability forcing a reevaluation of the company's true worth. All right, that's our take on Culp. And just a quick reminder, as always, this is not financial advice. All of this is for informational and educational purposes only.